Today's episode of the How to Trade Stocks and Options podcast is powered by FinClub and their artificially intelligent stock picks. With nearly 90% accuracy for the first half of the year, you'd be crazy not to try FinClub stock picks while you can. I mean, before they get bought out by one of the big Wall Street banks, because their technology really is that good. So head on over to tryfinclub.com to get nearly $1,500 in bonuses just for starting your free 2-week trial. So join the club, the Fin Club, to get nearly $1,500 in bonuses just for starting your free 2-week trial at tryfinclub.com. That's tryfinclub.com. Today on the podcast, we're going to be talking about why covered calls are a great way to start trading options. This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we give you the tools, tips, and tricks to help you trade faster and trade smarter. And here's your host, voted one of the top 100 people in finance by Redwood Media Group, founder and head trader of 10MinuteStockTrader.com, Christopher Uhl. Hey there, 10-minute traders. Welcome back to the How to Trade Stocks and Options podcast. Before we get started, real quick, please make sure you like, subscribe, and enable notifications. That way you never miss any of the tools, tips, and tricks that we upload every single week to help you trade faster and trade smarter. Now, today we're going to be talking about covered calls and why they are a great way to start with options trading. So, if you are interested in covered calls, that means you probably are interested in stock trading. And if you're interested in stock trading, then you understand the fundamentals of stock trading. You understand purchasing shares, selling shares, the whole movement that goes around it, right? Now we're going to add another component to this, which is a call option. So if you're going to do a covered call, you need at least 100 shares of stock for one call option, which can be kind of expensive, so keep that in mind. But there is an ideal scenario for covered calls, and that is number one, low basis, and number two, high volatility. So let's go over those real quick. Number one, low basis. That means the price of the stock is cheap. That is very helpful, especially if you're going to be buying all of them. Now, if you're buying all of them on margin, you can get by with about half, putting up half in buying power reduction. But let's say you have a $10 stock and you are buying 100 shares of that. So 10 times 100 is $1,000. You'll need to put up $1,000 if you're buying all of it. If you're on margin, you'll have to put up 50% of that. Now, there's different types of margins, but we'll just leave it at that. The ideal scenario, like I said, is low basis, high volatility. You don't want to be buying the $100 stock. You want to be buying the $10 stock because you're tying up a lot of capital just to start with here. All right? You're tying up $500 to get into these long 100 shares of stock on margin. Now, if there's high volatility, here's where things work better for you. You can sell the option for more money. Now, I like to look at the 30 delta option. The 30 delta means that you've got 70% of it being out of the money, but only a 30% chance of it being in the money. If you are selling an option and it goes in the money, that's actually a great thing. If you're selling an option and it stays out of the money, that's also actually a great thing. When you sell a call against 100 shares of stock, there's not really much that can go wrong. Think about it this way. If the stock goes down, you have sold the call option and you get to keep all that premium. Okay? Let's say you sold it for 30 cents. Okay? So you've taken in $30 on your $500 of margin you've put up. That's a decent return already. Okay? But let's say it goes down. Let's say the shares are losing value. You are offsetting $30 of that lost value by the call option. It could go down to $9.70 and you're still at break even. Now, if it goes up, let's say it goes up to 12. That 12 strike was the call option you sold. If it goes up to 12 and beyond, you're still keeping all of that call premium that you sold. And you're also keeping the difference in where you bought it at 10 up to 12. So you're keeping a lot of money. And then you know what? If it does go in the money, it gets assigned and called away and you never have to touch it again. But you've been able to make money. So it's a pretty great thing whenever you have a cover call that goes in the money. you're only selling one contract, so it's not an expensive trade to get into. If you use a broker like Tastyworks, it's only going to cost you $1 in commission against that one contract. You're reducing the price of what you bought it for. So let's say, this is kind of a cool way to think of it. Let's say that you are long 100 shares of stock and you've sold that 30 Delta call and you sold it for 30 cents. That means that you took in $30 of credit on your trade, and each individual share cost you $10. That means you just got 3 shares for free. Does that make sense? You've taken in $30 in credit, and each share costs $10. You got three shares for free. Can't beat that. Now imagine if you did this 6 months in a row. 3 times 6, that'd be like 18 shares for free. Basically, you're reducing your break-even price here by each amount of call that you're selling. But you could also think of it another way. You're getting free shares. So that's a cool way to look at it. And this is improving your probability of profit. So if you buy a stock outright, as you know, the only way it profits is if it goes up. You lose money as soon as it goes down. Well, if you sell the call, you get that buffer between the price that you've bought the stock at plus, or I should say minus what the call value was. So in this case, it go from $10 to $9.70. So that is why covered calls are a great way to start trading. You're familiar with the basics of being in stock, but now you have a lot of things extra to help you with it. You've increased your oomph in the trade. You've made it a better trade because now you've got a couple of shares for free if you want to look at it that way. You've reduced your break-even point if you want to look at it that way. And as long as you hit that ideal scenario of low basis, high volatility, you're in a great place. Now, granted, things can go wrong, but if you are long stock, this is an easy way to improve that trade without taking on any additional risk, because that long stock offsets the one short call. So there is no additional risk when you do this. Only additional profits, I guess you could say. So hey, listen, I hope you found that helpful. Why covered calls are a great way to start trading. So if you could, please make sure you like, subscribe, and enable notifications. That way you never miss any of the tools, tips, and tricks that we upload every single week to help you trade faster and trade smarter. And I'll see you on the next episode. Hey, did you realize that you could get the secret weapon that every investor needs right now to start changing your financial future for free? Yeah, that's right. Just head on over to triplestockprofits.com and download your free Triple Stock Profit System ebook today.
10MinuteStockTrader.com content is for information and educational purposes only. It is not, nor is it intended to be, trading or investment advice or recommendation that any security, futures contract, options contract, transaction, or other financial instrument or strategy is suitable for any person. Trading securities can involve high risk and the potential for total loss of any funds invested. 10MinuteStockTrader.com and Christopher Uhl, through its content, financial programming, or otherwise, does not provide investment or financial advice or make investment recommendations. Investment information provided may not be suitable for all investors and is provided without respect to the individual investors and audience's financial sophistication, financial situation, investing time horizon, or risk tolerance. 10MinuteStockTrader.com and Christopher Uhl are not in the business of trading securities trades, nor does it direct client commodity accounts or give commodity trading advice tailored to any particular client situation or investment objectives. 10MinuteStockTrader.com and Christopher Uhl are not licensed financial advisors, registered investment advisors, or registered broker-dealers. Stocks, options, futures options, and other financial instruments not included here involve risk and are not suitable for all investors. You alone are responsible for making your investment and financial trading decisions and for evaluating the merits and risks associated with the use of any financial security and broker platform. For more information, please visit 10MinuteStockTrader.com/legal. Thanks for stopping by.